I've been asked what's the difference between administration and liquidation. They're both forms of insolvency procedure that are applicable to companies. Typically, administration will be applied in situations where there's deemed to be a viable core to that business, and the administration process puts a sort of legal protective cloak or wrap around that business such that individual creditors aren't able to take their own action against it to recover the repayment of their debts. It gives the company and the administrator who's appointed to deal with it time to examine the operations of the company, its funding, and to determine whether it can be reorganised, restructured and refunded and continue to trade, having been handed back to its directors, or if the company can't be saved in whole, whether or not at least there's a viable core to it that can possibly be taken out of the legal structure of the company but given a new life, either with a third party buying it or it being restructured within the existing company, such that some of the jobs, if not all of the jobs, can be saved and that the entity survives to trade going forwards. That's to be contrasted with liquidation, where typically the liquidation process is chosen when it's considered that the company has reached the end of its useful life. It's generally thought that there isn't sufficiently large, viable core to that business that can be protected and sold on to another party to take forward. So it's more of a process of ceasing the trade of the business and to sell the various assets piecemeal and then to distribute the proceeds back to the people that are owed money by that company.